2025 is here, and the stock market is buzzing with incredible opportunities waiting to be seized. But how do you identify the finest ones to protect your financial future? ETFs can help with that. In this video, we will list the top 5 ETFs to purchase in 2025, the ones that are expected to boom this year. These ETFs are made to capitalize on new trends, increase the diversification of your portfolio, and optimize your profits. These choices could revolutionize your 2025 investing strategy, regardless of your level of experience. You're staring at a list of ETFs, thinking, which one should I pick? You know that choosing the right ETF could make a huge difference in your portfolio, but how do you decide? Before coming to the top 5 ETFs, let's discuss 3 must-know factors briefly that will help anyone to make that choice with confidence. Number 1, risk tolerance. Imagine you're walking a tightrope. The higher you go, the more risky it feels, right? Well, choosing an ETF is a lot like that tightrope walk. The first thing you need to consider is your risk tolerance. How much risk are you willing to take on? Are you comfortable with the ups and downs of the market, or do you want something steadier? Some ETFs focus on safer investments like bonds or blue chip stocks, which tend to move slower but with less dramatic ups and downs. These are great for people who want stability. Others dive into emerging markets or tech stocks, which can rocket to the moon or crash hard. The key is knowing where you fall on that spectrum. Low risk, go for more stable ETFs. High risk, look for growth-focused options that offer big potential returns. Number 2, low expenses. Many people overlook expenses. It's like paying for a treasure chest with hidden holes. You think you're getting rich, but little by little, your returns are leaking out. Expense ratio is the fee you pay annually to the fund manager to handle the ETF. It might sound small, but over time, it adds up. For example, let's say you invest in an ETF with a 1% annual fee. At first glance, that doesn't seem like much, but over 20 years, it could cost you thousands in potential returns. Low-fee ETFs are the hidden gems you need. Even a tiny difference in fees can lead to major gains or losses over time. So always look for ETFs with low expense ratios. They may seem like small savings today, but they can make a huge impact tomorrow. Third, and the last, market exposure. Market exposure is like planting a variety of seeds in your investment field. The more diverse the plants, the stronger your garden grows. When you choose an ETF, you're not just picking a single company. You're investing in an entire sector or market, which can help you spread out your risk. Now, you've got the big 3 to consider: risk tolerance, low expenses, and market exposure. These factors are your roadmap to choosing the right ETFs for your financial journey. Now, let's explore the ETFs that have the potential to rise so that you don't lose out. Number 1, Schwab US Dividend Equity ETF, SCHD. SCHD is an excellent option for investors seeking high yield and dividend growth. It focuses on high-quality U.S. companies with a strong track record of paying and growing dividends. In the past 12 months, SCHD is up nearly 10%, and it includes big sell-off. SCHD currently has assets under management of $65 billion. Expense ratio is just 0.06%. There is a big opportunity, especially for long-term investors, as interest rates will be coming down, hopefully. Now, if we look at sector breakdown, top 5 sectors are financials with 18% exposure, healthcare 15%, consumer staples at 14%, industrials 13%, and energy around 12%. CHD is a good option because it will diversify your portfolio. Top holdings includes Pfizer, ABBVIE, Coca-Cola, Cisco Systems, BlackRock, Bristol-Myers, Texas Instrument, and PepsiCo. Number 2, Schwab US Large Cap Growth ETF, SCHG. SCHG is a popular choice for investors looking to gain exposure to large cap growth stocks. Considering current market trends and economic forecasts, there are a few key points to consider. Number 1, SCHG targets large cap growth stocks, which are typically companies with strong earnings growth potential. These stocks tend to outperform during periods of economic recovery and expansion, which could be beneficial in 2025. SCHG includes leading companies from sectors like technology, consumer discretionary, healthcare, and more, which are known for driving long-term innovation and value. In the past 12 months, SCHG is up nearly 40%. SCHG currently has assets under management of $37 billion. Expense ratio is just 0.04%. If we look at sector breakdown, we found that technology is leading with 48% exposure, communication at 13%, consumer discretionary at 12%, healthcare 11%, and financial around 7%. As an investor, you need to understand these exposure rates because if your portfolio is already overexposed to technology sector, then SCHG will just further increase the overexposure rate. Now look at top holdings: Apple, Nvidia, Microsoft, Amazon, Meta Platforms, and Tesla. So if you are looking for big mega cap companies, then SCHG is a good option. Number 3, Vanguard Value ETF, VTV. VTV targets large cap value stocks, which are companies that are considered undervalued based on fundamental metrics such as price to earnings and price to book ratios. Value stocks tend to be more stable and less volatile compared to growth stocks, making them appealing for long-term conservative investors. In the past 12 months, VTV is up 13%. VTV currently has assets under management of $147 billion. VTV has an expense ratio of just 0.04%. Now look at the sector breakdown of VTV. Financial is at the top with 22% exposure rate, industrials at 16%, healthcare 15%, and consumer staples 8%. If you look at the holdings, you will find Berkshire Hathaway, JP Morgan, United Health, Walmart, and Broadcom. Number 4, Vanguard Total, Stock Market ETF, VTI. VTI is considered a strong option in 2025 because VTI provides exposure to the entire U.S. stock market, covering large cap, mid cap, small cap, and micro cap stocks. This diversification reduces the risk associated with investing in individual sectors or companies while allowing investors to capture the growth of the overall U.S. economy. In the past 12 months, VTI is up 24%. VTI has a very low expense ratio of just 0.03%. Now look at sector breakdown. Technology is at the top with 33% exposure rate. Consumer discretionary at 14%, industrials 13%, financial 11%, and healthcare 10%. If you look at the holdings, you will find Apple, Nvidia, Microsoft, Amazon, Facebook, Alphabet, and Tesla. If your portfolio is already not overexposed to technology sector, then VTI is a great option. Number 5, SPDR portfolio, S&P 400 Midcap ETF, called SPMD. Investing in SPMD in 2025 offers several potential advantages. Mid-cap firms often combine the stability of established businesses with significant growth opportunities. They have typically outgrown the volatility of small caps, but still possess substantial room for expansion compared to large caps. This balance can lead to attractive risk-adjusted returns for investors. Given the current market dynamics, there is potential for small and mid-cap stocks to outperform, fueled by factors such as falling interest rates and favorable regulatory conditions. Investing in SPMD provides exposure to this segment of the market, aligning with these potential growth trends. In the past 12 months, SPMD is up 16%. Expenses ratio of SPMD is very low, that is just 0.03%. Looking at the sector breakdown, finance is at the top with 50% exposure rate, producer manufacturing at 20%, technology services 14%, electronic technology 14%, retail trade 13%. Main holdings are Williams-Sonoma, Illumina, MCOR Group, Expand Energy, Interactive Brokers, Pure Storage, and Burlington Stores. These 5 ETFs could be great options for building a strong and balanced portfolio in 2025. Remember to diversify and choose investments that match your goals. Always take time to research or talk to a financial advisor before making decisions. And don't forget to share your thoughts in the comments and subscribe to the Finance Flowchart channel for more tips and insights.